Tantor Audio, a division of Recorded Books, presents The Everything Guide to Investing in Your 20s and 30s by Duarte, M.D. Narrated by James Fouhey. Introduction. In the modern world of investing, you'll find more options than ever before. You can invest in stocks, bonds, real estate, mutual funds, ETFs, cryptocurrencies, IPOs, and dozens more. But what's the difference between all these options? Which ones are safe? Which ones are risky? Which ones offer the greatest return on investment? And how do you know which one is the best for you? Here you'll find the answers to these questions and more. You'll learn all about investing for people like you, people in their 20s and 30s who wish to build wealth over their lifetime. It is not about getting rich quickly or how to become a professional trader. Instead, it's about following your roadmap to investing and putting in some hard but rewarding work. In this book, you'll learn how to evaluate and invest in all of these different options while developing, shaping, and adjusting your long-term plan. How willing you are to take risks with your money. How to manage that risk to make money. All about choosing asset classes such as stocks, bonds, real estate, and mutual funds to create an asset allocation mix that makes sense for you. Most importantly, you will learn how to develop a plan through which you will build your wealth without guesswork and anguish. If you've never invested before, that's okay. No matter what, as long as you are in your 20s and 30s, time is on your side. If you start investing now, you will have ample opportunities to build the kind of financial future that you are looking for. Time to get started. Chapter 1. Are you ready to become an investor? It's important to understand the big picture. Investing is the long-term process by which you build wealth, and has two basic components, saving and compounding. Saving is the act of putting money away for the purpose of investing. Compounding is what money does for you by earning interest, by the price appreciation of your investments, or both. Together, these two processes grow your money. Once you understand these concepts, you are ready to get started. Can you afford to invest? You have to start somewhere. At the early stages of the investing process, important questions should be raised. Simply stated, investing without money is like quenching thirst without water. So a great place to start is by asking the question of whether you can afford to invest. Once you've answered this crucial question, other logical questions will follow. How will you finance your investing? The money you use for investing can come from anywhere, a savings account, an inheritance, or even a lottery win. For most people, investment money is money earned from a job or profession, even a side gig. If you've got some money already put aside, you're ahead of the game. The more you have, the better your starting point. One thing to keep in mind: never borrow money to invest until you gain experience and know your way around the markets well. That one act would start your investment plan at a deficit. Essential. Build your savings first. Billionaires build their fortunes by owning and managing their businesses. The stock market is a place where they preserve the purchasing power of their fortunes. For example, Warren Buffett, through his holding company, Berkshire Hathaway, owns businesses such as Geico, multiple local real estate companies in key states such as Texas, and General Reinsurance Corporation. He uses the profits from his businesses to buy stock in other companies such as Coca-Cola and Apple. That way he diversifies his holdings, but also earns dividends and price appreciation from the stock market. A simple way to figure out if you can afford to invest is to count how much money you have left at the end of the month after all your bills are paid. If it's $100, that's as good a place to start as any, and that is money that will be put to good use by saving it in a bank account or a money market mutual fund. A money market mutual fund is a special type of mutual fund that invests in short-term interest-paying bonds, maturity of less than 90 days, such as U.S. government treasury bills or what is known as commercial paper, similar short-term bonds issued by corporations. Think of a money market mutual fund as a holding tank for your money while you decide what to do with it. Any amount is good, but the more you have, the better off you will be in both the short and long run. So if it's less than $100, it means that you need to work a little harder at controlling your expenses, or figure out how to make more money, such as exploring a side gig or working overtime. However, be careful that this doesn't interfere with family or other important aspects of your life. Still, even $100 is better than nothing. Alert. Pay off as much debt as possible before you start investing. Debt is a drag on your ability to save. Think of debt as a big sack of potatoes that you carry on your back everywhere you go. By paying debt down and eliminating it altogether, you are taking a big weight off of your financial shoulders. Being lighter makes you move faster. No matter what, it makes good sense to have at least $1,000 saved before you make a move, such as buying shares in a mutual fund that invests in stocks or bonds, a good entry-level place for investors. If it's possible, always go for more. So if it was easy to save $100 the first month, get greedy and go for $200 next month, so you can grow your nest egg more quickly and benefit more from compounding. If you don't have extra money at the end of the month, there is no point in trying to invest yet. In that case, your first step should be to trim your expenses. If you're trying to make money without some kind of reliable backing, you're asking for trouble. So don't put your rent or food money into a mutual fund. You may find yourself without a place to live or going hungry. Details are important. Successful investors are very specific about what they are going to do and how they are going to do it. For example, plan what you will set aside for investment, how often you will invest it, and how you will monitor your progress. As time passes and your investments grow, make changes if and when they are needed. Consider revisiting your goals and your expectations. A reliable plan in the early stages of investing is to set aside at least $100 per month until you get to $1,000. While you are saving money to invest, you should also be researching different mutual fund companies to find out which one makes more sense to you. Some of the more popular and reliable mutual fund companies are Fidelity Investments, Vanguard, and T. Rowe Price. Essential. The major reasons most small investors give up is that they don't have enough cash and that they risk too much too soon. That means that they don't have enough money around to get them through tough times or to recover from mistakes. Markets will always rise and fall, so in order to stay in the game, set aside as much as you can before you try to put it to work. Then keep adding as much as you can as often as possible. That's how you will make the most out of compounding. Know your risk profile. Knowing how much you are willing to risk in investments is a tricky business, as it depends on both your personality and your ability to be objective based on your circumstances. If you are willing to jump out of an airplane without a parachute, you might like to trade options and futures without doing your research or doing some paper trading without risking real money. Of course, that's not wise, and I don't recommend it, even if you are an ex-CIA agent used to taking outlandish risks. But by the same token, people who don't like to leave their house if there are clouds in the sky don't make good investors either. Alert. Trading options is risky, but it's a great way to invest if you're trying to build income. Consider this technique only after you've learned about stocks and are experienced in the investing world. Still, it makes sense to know what your tendencies are. Once you know, you can explore the different kinds of investments and methods that may make sense for you. Regardless of your risk profile, as an investor, there is no substitute for planning, study, risk understanding, and patience. What's the best way to figure out your risk profile? Ask yourself these 3 questions. How much can I afford to lose? How much do I need to reach my goals? How do I react to losing? If you have only a few $100s to your name, and you need them to get by, you should avoid high-risk investments and concentrate on saving money that you will invest in the future. Essential. Take your time before deciding, and don't be afraid to reconsider a decision. If you are uncomfortable, consider taking other steps to remove your uncertainty. To decrease anxiety, trade on paper where you put imaginary money to work, and follow the results without risking real cash. Invest in what you enjoy or are good at understanding. If stocks are not for you, consider real estate, bonds, or even something like investing in a franchise. There are many asset classes and investment opportunities, each one with its own set of risks and potential rewards. A good rule to follow is that if you don't understand it, you shouldn't invest in it. Think things through. If your goal is to have $1 million by the time you retire and you are only 23 years old, you're in good shape as time is on your side. In this case, everything depends on how much money you can save over time and how well that money can be invested in order to maximize the combined savings and compounding dynamic. If you get sick to your stomach and pull your hair out when your favorite football team loses a game, lower risk investments may be the way to go for you, especially when markets become volatile in response to an unexpected event that is well beyond your control. Setting realistic goals and timetables. Your timetable starts when you decide to start investing. Your first step is to decide when you will open your account and how much you will put in it. If you have money set aside, you're ahead of the game. If you have less than $1,000, your best bet is to put that money in the bank or in a money market mutual fund and continue adding to the account until you have enough to start investing. Avoid putting that money in a CD, certificate of deposit, or another type of account that won't allow you to add to it or that will limit how often you can put money in or take it out. Put it in writing. Wishing for something won't help you get it, but writing your goals on paper, reading them frequently, and reviewing and refining them will get you places. The more specific you are, the better off you'll be. Note the goal, the time frame to reach the goal, the amount of money you'll need, how much you have now, and what you are willing to do to get to your goals. If your long-term goal is to retire early, write down the age of retirement, where you'd like to live, and how much money you think you'll need. Write it in such detail that you can see yourself doing it. I want to retire when I'm 50. I want to move to Cape Cod and live in a house by the shore with a great view of the sea. I plan to do a little consulting work on the side and run along the beach with my dog every day. Experience this fully every time you look at your sheet of paper or your smartphone. If you have shorter-term goals, like owning a home or visiting a specific foreign country, include those as well, and divide your savings and investing capital between them. Break the process down into stages. Set monthly, quarterly, and yearly goals. Write down exactly how much you'll put into your IRA or 401k every month. Decide how much you'll pay in debt every month, and to whom and how much money you will dedicate to each area. This process will require a great deal of time and planning, and it's likely to require adjustments along the way. Review and refine your plan. Keep a set of lists with clear and concise objectives and revise them frequently, sometimes every day. The time interval between checkups and changes is up to you. The key is to get in the habit of making your financial situation something you monitor and adjust as frequently as it makes sense, especially when your situation and your needs change. Most of all, Keep track of how much progress you're making. Do what makes you comfortable, but check at least on a monthly basis. Moreover, consider getting help as needed. For example, is your spouse or significant other participating in the plan? Does that person understand the goals? If it's not going the way you planned, take a step back and review the situation on your own, perhaps, and then together once you've given it some thought. Give yourself credit for what you've accomplished, and review where things didn't go as you planned. If your goals change, it's not a setback, just a reboot. Go through the same process of planning for your next goal. Simply talking things over with friends or relatives may be helpful. If what you're doing isn't working, it may be time to get a second opinion. Successful people are usually willing to lend a helping hand to those in need. By raising the issue with someone who's been there, you may discover that your problem isn't as big as you think. The answer may be something as simple as getting a recommendation for a good advisor who is willing to be your consultant, or the name of a good investment club. Find some good online resources for retirement planning and personal finance, like MarketWatch.com's personal finance and retirement sections. The personal finance section offers great ideas for budgeting, saving money on credit cards, how to get bargain trips, and great general tips on how to save money. The retirement section is terrific for getting organized and staying updated on changes in mutual funds, IRA rules, and what to do with your 401k plan. Discount brokers are great resources for baseline savings and investing information. The key is to continue to build capital. So even if you're stuck, continue to put money in that savings account or money market mutual fund as you figure out your next move. Just that simple step will keep your future investment fund growing. How much will you need to get started? Theoretically, you can start with a nickel. But in the real world, the more you have when you start investing, the better off you'll be. What's even more important is gauging how much you'll need to save and invest over time, and to adjust this accordingly as your financial situation changes. A rule of thumb used by some mutual fund companies is that you should save 8 times your annual ending salary, the money that you have after taxes and expenses, in order to retire. It's not likely that a young person can do that right away, so it can be done in a stepwise fashion. For example, if you start at age 25 and you save 1 time your ending salary by the time you are 35, the next goal should be to save 3 times your ending salary by the time you're 45, 5 times by the time you are 55, and so on. Remember, this is just a formula. Life isn't always this neat, but you do have a benchmark. You can modify this formula by starting to save earlier, adjusting the amounts more frequently, or changing your retirement age goal. You can also try to put more money away every chance you get, as long as you stick to the goal amount. Become a savings machine. If you have a 401k plan as your main retirement source, max that out and start a separate IRA to add more money to your retirement. Alert. Searching through the free content on a mutual fund or bank website can give you a fair amount of useful information. Just be aware of the fact that their goal is to get you to invest your money with them. Make sure that you use the information that is sensible without necessarily buying into a sales pitch. Always think liquid. You've got some savings, you've got a plan, and you're looking for ways to get things moving. One of the most useful things to do in investing is to consider the flexibility or liquidity of any investing vehicle. Liquidity is the ease of moving the money around. Cash in hand is the most liquid of assets. Liquidity certainly comes in handy if something changes, such as a sudden short-term price drop in the stock market that gives you an opportunity to buy shares at lower prices. Let's say that you get a side gig that pays quickly, or you get a bonus or a raise at work. Suddenly, you have extra money. That extra money could take you to your $1,000 initial investment target, letting you start your investing plan sooner than you might have intended. If your savings is locked up in an illiquid CD that won't let you move the money around for 6 months or a year, you'll be stuck and will have to wait until the CD matures before you can get started on your longer-term investment plan. Bank accounts versus money market mutual funds. Bank accounts and money market mutual funds are the most liquid savings and investing vehicles. And although they are similar, they are not the same. You set up a bank account with the bank, and you open the money market mutual fund with a brokerage or mutual fund company. Savings accounts pay interest rates. Checking accounts sometimes pay interest. Money market mutual funds pay interest rates and have check-writing privileges, but they often require as much as between $1,000 to $2,500 minimum balance, and some may limit the number of checks that you can write from the account. Therefore, a good rule is to have a bank account for savings, a checking account for paying bills, and a separate money market mutual fund as the central holding area for investment capital. Essential. Build investment capital by putting money in your money market fund before you put it to work. By delaying transferring money directly into a stock or bond fund, you are providing a cushion against potential losses and building up your cash reserves. This money may come in handy in the future, especially if the markets fall, giving you an opportunity to buy shares in your stock or bond fund at a cheaper price. You may be able to set up your money market fund to automatically transfer money from your bank account. Bottom line, if you put $500 into your money market every month, only invest a portion that you are comfortable with, such as $250, in your stock or balanced mutual fund. Open a money market mutual fund account as your initial investment decision. This account will serve as your central investment account. From there, you can switch money to mutual funds, stocks, and other investments with a phone call or a click of your mouse. Fact: you can set up a brokerage account or a mutual fund account, or both. The difference is that with a brokerage account, you can buy stocks, bonds, and mutual funds, while a mutual fund account only allows switching between the mutual funds in the fund family that houses the account. At the same time, if you are not interested in stocks or bonds, a mutual fund account will work just fine for you. Next, you'll decide how much money you'll set aside for investing and how often you will add to your investments. A good method is to add at least a constant or nearly constant amount every month. If your goal is $100 every month, but you only have $50 this month, add the $50. Try to add $150 next month. No matter what, just keep adding to your account. Alert. Separate savings from investments. Once you have enough money to invest, split your funds between a bank savings account and a mutual fund/brokerage money market account. You need to have some money in the bank for emergencies so that you don't have to tap your investment account unless it is absolutely necessary. Even if you check your balances every week or month, give your accounts a thorough checkup every 3 months. If you're not where you thought you should be, ask yourself why and do your best to make it right. You can adjust your timetable to conform to your circumstances. Things happen, so if you lose your job or a health emergency pops up, things may get difficult for a while. Stay patient and do your best to stay on track. But if you get a promotion and a raise, give your investment account a raise too and modify your addition schedule. When you reach a milestone, as in when you get to your first $10,000, see what you can do to get to $20,000 faster than what it took to get to $10,000. Then do it again when you get to $30,000. Always give yourself room for error, but always make changes and look for ways to make your returns better. Investing is a fluid process, and those who keep up with what they are doing in a systematic fashion do better. Know before you invest. Once you've opened your investment account, keep that money in the money market mutual fund as long as it takes for you to decide what to do with it. Shares in a money market mutual fund do not fluctuate in price. Although you are buying shares, each share is worth $1. That won't change unless very difficult financial circumstances develop. It's only happened once in the history of investing, during the 2008 financial crisis. Take your time and try out some strategies on paper before committing to real-time investing. You can buy shares in a growth mutual fund on paper and follow the share price over a few weeks. Correlate how the fund does in relation to the stock market. If conditions remain the same and the fund does well over the period, pull the trigger and keep an eye on things. Fact: the Federal Deposit Insurance Corporation, FDIC, does not insure money market mutual fund accounts. Money in these accounts is at risk of loss. The good news is that even though it can happen, the odds of losing money in a money market account are almost zero. Once you've done some research, it may make sense for you to invest in a well-managed mutual fund that invests in stocks, bonds, or both, a balanced approach. If you know someone who had good results with a particular mutual fund, research it for yourself. Here's where talking to your mom, your dad, or an uncle or friend of the family with some money may come in handy. Alert: a mutual fund prospectus tells the story of what to expect when you buy shares of the fund. Not only will it describe the fund's investment philosophy, its current holdings and allocation, and its overall approach to investing, but you will also get a snapshot of past performance. And while history isn't everything, knowing how a fund performs during a bad market is essential if you are trying to decide whether to hold shares for several years, especially during bear markets. Don't bank on their advice too much, though. Get the prospectus and see for yourself. Monitor the share price. Compare the fund's performance to the stock market and see how it has behaved during similar periods of economic activity and interest rates in the past. Explore both how well the fund has done over time and how well it's done recently. Start following its price on a weekly or daily basis for a few weeks. Always compare your funds or your stocks to the appropriate benchmark and to the general market. When you read a mutual fund prospectus, it will always tell you which major stock index it is trying to emulate or beat. Most diversified growth or growth and income mutual funds will use the Standard & Poor's 500 index, S&P 500, as a benchmark. Essential: when investing in individual stocks, kick the tires before you buy. That means going to the supermarket and seeing if anyone is buying products made by that company, seeing how many cars are parked in the parking lot of a certain company which retails specific products, and listening for which companies get a lot of press in financial circles. Use this as the starting point for your research, then follow it by reviewing earnings and research reports, asking questions, and getting a long-term view of the company from a stock chart. You can find excellent stock charts on the web at stockcharts.com. Once you get better at investing and start to invest in individual stocks, it's a similar dynamic to investing in a mutual fund with a bit more detail. With a mutual fund, you're investing in a management style, expertise, and investment strategy. With an individual company stock, you're investing in the potential for profits of one entity. Yet, it's not that different. Get as much information as possible on the company. Ask people about their experience with the stock. Research the company and its products. Know its fiscal strategies, its management style, and review its future plans. For example, if you go to a coffee shop on a regular basis, it's always crowded and it's part of a major chain like Starbucks. Research the company. see how it's doing, and consider investing in it. The basics of market analysis. Individual investors have a responsibility to their future and to their family.
Sample complete. Ready to continue?